Hey everybody, Dr. Phil here. This is going to be a video on interest rates and bond valuation. So let's go ahead and jump right into it. So let's start talking about bond prices, features, some of the things that you need to know. So whenever a corporation or a government wishes to borrow money from the public, usually on a long-term basis, it will typically do so by issuing or selling debt securities that are generically called bonds. So you can think of a bond as like a type of loan. As it says, normally interest-only loans. That's how a lot of schools get built. Universities, public universities, of course, by bond issues. So let's look at an example. So suppose the Beck Corporation wants to borrow $1,000 for 30 years. The interest rate on similar debt issued by similar corporations is 12%. So Beck will thus pay 0.12, that's your 12%, times the 1,000. So they're going to pay 120 in interest every year for 30 years. So at the end of the 30 years, Beck will just then repay the 1,000. So think of it like you give the company your money, the $1,000, you get 120 every year for 30 years, and then they just give you the money back, basically. So let's talk about some terms. Coupon. Coupon is the stated interest payment made on the bond. So that in this case it would be 120, right? The 12% of the thousand. The face value is, or we sometimes call that par value. So that's the principal amount of a bond that at the end of the term is then just repaid. They put repair. I think that's supposed to be a D, repaid. The coupon rate is the annual coupon divided by the face value. So if you take the 120 divided by the 1,000, again you just once again get that 12%. And then maturity is the specified date on which the principal amount of a bond is going to be paid. So think of the maturity as the ending date of the bond. Now, obviously, as we know, think about what interest rates have been doing recently. We actually talked about this before. Interest rates change over time, right, in the marketplace. But the cash flows from the bond remain the same. So as a result, the value of the bond will change because interest rates in the market are changing relative to the bond's fixed interest rate. So when interest rates rise, the present value of the bond's remaining cash flows goes down and the bond is worth less, right? Because people are like, well, there's a better rate I could get in the market. But when interest rates fall, the bond is actually going to be worth more. So in order to find the value of the bond at a particular time, we need the following information points. So the first thing we need is the number of periods, excuse me, remaining until maturity. We need the face value. We need the coupon. So think about the rate, and then we need what's called the YTM, yield to maturity, which is the required rate in the market on a bond. So let's look at an example. So suppose Xanth Company were going to issue a bond for 10 years to maturity. The Xanth bond has an annual coupon of $80. Similar bonds have a yield to maturity of 8%. What would this bond sell for? So the bond will obviously pay $80 per year for the next 10 years in coupon interest. So in 10 years, Xanth will just simply pay the 1,000 that they originally loaned. They'll just pay it back to the owner. At the going rate of 8%, the present value of the 1,000 paid in 10 years is as follows. So we can look in the factor table. So we've got 1,000 over 1.08. So think about the 1.0810. And then if we do the reciprocal, we get 1,000 over 2.1589. So thus, the amount of what it's worth currently, the present value is 463.19. So the bond offers $80 per year for 10 years. So the present value of the annuity stream is just simply the $80 times, and then once again, we use our formula, 1 minus 1 over, so this is the reciprocal, 1.08 to the power of 10. Where is the power of 10 coming from? That's the number of periods, the term, 10 years, and then again divided by the interest rate, 0.08. So we get 536.81. So then what we're going to do is we're going to add the two values together. So let me just go back real quick. So what we calculated here, the 463.19, that was the present value of you getting the 1,000 back at the end. The 536.81 is the present value, discounted back to today's dollars of all those, interest payments that you're going to get in the future. If we add them together, guess what we get? We get exactly $1,000. So this bond sells for exactly the face value. So it's what we call a par value bond. So another way we could express this is as follows. So you can kind of see this timeline here, right? 10 years, and what do you notice? Like every year, we're just paying out the $80 every year. So let's say that a year has now gone by. The Xanth bond now has 9 years to maturity. If the interest rate in the market has risen to 10%, what will the bond be worth? So the present value of 1,000 paid in 9 years at 10% is again, just plug in your numbers, we get $424.10. And then we need to do the same thing. We're going to offer the $80 per year, but remember now it's not for 10 years, it's only for 9 years because 1 year has already gone. So the PV, the present value of the annuity stream, plug in your numbers. Again, 80 is the interest rate. 1 minus 1 over, that's the reciprocal. 1.10 to the power of 9. Go ahead and simplify that, and you'll get that 2.3579. And then it's just 80 times 5.7590. So the present value of the annuity stream, because there's now only 9 years left, not 10, is $460.70. Just again, just like we did before, add them together, and we get 884.82. So the bond sells for less than face value, so it's a discount bond. Now think about why that makes sense. The market interest rate's paying more, so you would expect that this would now be worth less than 1,000, as you see, 884.82, because it's now selling for a discount, because interest rates in the market have gone up, but whoever's got this is kind of locked in at that lower interest rate. So what if it was what was called a premium? Whenever you think about premium, think about the company's bond is paying more than the market. So what would the Zant bond sell for if interest rates had dropped by 2% instead of rising by 2%? So in other words, let's say that the coupon rate of 8% when the market is now only 6. Okay. So the present value of the 1,000 would be, so we'd start with your 1,000. It's going to be over 1.069. Look in your table. Equals 1,000 over 1.6895. And we get 591.9. Just call it 592 bucks. So then we say, all right, well, that's the present value of the 1,000 we're going to get in the future. But what is the present value of all those interest payments I'm going to get? So you can see what they've done here, right? 80 times 1 again minus 1 over. There's your reciprocal kicking in again. Over 1.06 to the power of 9 because there's 9 periods left. Again, divided by the interest rate, 0.06. And we get 544.14. If we add them together, we get 1136.03. So again, is it over the 1,000? Remember, the $1,000 is the par value. Anything below is a discount. Anything above that is any present value that you calculate below that is a discount. Any present value over that is premium. So we can see here 1136.03. So this is now selling at a premium. Now let's talk a little bit about interest rate risk. So interest rate risk, this comes up because, as you know, interest rates fluctuate, right? And the degree of interest rate risk a bond has is going to depend on its sensitivity to interest rate changes, which really depends on two things. One, time to maturity, because you think about it, the longer you've got left till it matures, the more time the market has for interest rates to change. And then two, what is the coupon rate on, whatever your current bond is? So all other things being equal, ceteris paribus, as we like to say in academia, number one, the longer the time to maturity, obviously, like I just said, the greater the interest rate risk. And number two, the lower the coupon rate, the greater the interest rate risk. So interest rate risk increases at a decreasing rate over time because as you think about it, as you start the bond, that's when it's really at its highest because you've got the maximum amount of time left. As you get towards the end of the bond, you've got less time left, hence the risk decreases. So we can illustrate the effect of interest rate risk using the 100-year, yeah, believe it or not, they do have 100-year bonds, Bell South AT&T issue. So you can see the maturity, 2095, 7% coupon rate. They've got the price on 12/31/95. That's what they'll pay back. And then the price on 3609 was 803.48. The percentage change in price from 1995 to 2009. Look at that, just say negative 20%. The price on 11/8/19, 122,950. So it's at a premium. Percent change in price from 2009 to 2019 is actually gone up 53%. So you can see it's kind of gone down and then it's gone back up. So you can kind of see, you can kind of see that rate, you can see that rate illustrated. So here's like it's a kind of a graph just kind of showing you this. Now look at the slope of the line connecting prices. You notice it's much steeper for the 30-year bond, right, than it is for the 1-year bond. So what that tells us is that relatively small changes in interest rates will lead to a substantial change in the bond's value, right? So just think about why the blue line here you see is the 1-year bond. It just doesn't have that much time to change, right? The green line denoting the 30-year bond, because it's for 30 years, it's for so much longer. 30 times the period of time as the blue line, it just has more time to change. All right, let's take a look at what we call YTM, yield to maturity. So a bond's yield to maturity should not be confused with its current yield, which is the bond's annual, just the annual coupon divided by its price. We just saw that in a previous example. So in the example we just worked on the previous slide, the bond's annual coupon, you remember, was at $80. They were just paying that $80 interest every year, and its price was $9.55. So the current yield, we just divided out 80 over the 955, so the current price, and we get 8.38%. So let's say that a bond has a quoted price of $1,080.42. It has a face value of $1,000, a semi-annual coupon of 30, and a maturity of 5 years. What is its current yield? What is its YTM, yield to maturity? Which is bigger and why? So notice that the bond makes semi-annual payments of $30. So the annual payment is 60. Remember, semi-annual is 2 times a year. So the current yield is just 60 over the 180.42, and we get now notice that's 0.055. Don't confuse that with 55.5. It'd be great to have a bond that paid 55.5%, right? You can sign me up for that one. That's obviously 5.55%. So to calculate the yield to maturity, the YTM, we just go back to previous example, 7.1. In this case, the bond pays $30 every 6 months and has 10 6-month periods until maturity. So we need to find R as follows. So you can see I plugged in the 1,080.42. That's the current quoted price, equals 30 times. And then again, you're probably getting used to this formula by now. So after kind of playing around with this, some trial and error, we find that R is equal to, it's just over 2, it's about 2.1%, just under 2.1%. The tricky part is that the 2.1% is the yield for 6 months. So we have to double that because we're looking for YTM. So the yield to maturity is just that times 2. Because think about it, 2.1 is for 6 months. Okay, we need a year, so it needs to be 4.2. Okay, now that of course is less than the current yield. So the reason is that the current yield ignores the built-in loss of the premium between now and maturity. Again, think about how those rates fluctuate. All right, let's talk about bond yields. Bond yields. So let's say you're looking at 2 different bonds, and they're identical in every way. So like we always like to say, ceteris paribus, except for their coupons and of course their prices. Both have 12 years to maturity. So the first bond has a 10% annual coupon and sells for $935.08. The second has a 12% annual coupon rate. So the question is, okay, well, what do you think it would sell for? So because the 2 bonds are pretty much identical, they're going to be priced to yield at about the same rate. We first need to calculate the yield on the 10% coupon bond. Proceeding as before, we know that the yield must be greater than 10% because the bond is selling at a discount. The bond has a fairly long maturity of 12 years. We've seen that long-term bond prices are relatively sensitive over time to interest rate changes, so the yield is probably closer to 10%. So we do a little trial and error, and we find out that the yield is actually closer to 11%. So you can see where I plugged in the numbers, the bond value, plugged in the 100. And again, the formula 1 minus 1 over 1.11 to the power of 12%. And then divided by 0.11 plus, again, this is just simplifying it out. And then what do we end up getting? We end up getting 935.08. So again, think about the 935.08. It's less than the 1,000 coupon rate, right? So if we look at this, we go, okay, this bond is apparently selling for a discount because it's less than the 1,000. So with an 11% yield, the second bond will sell at a premium because of its $120 coupon. So its value is, and again, let me just say this real quick. Obviously, you look at this, it says we'll sell at a premium. Go right down to the number. Is it over 1,000? Yes. Okay, it's selling at a premium. All right, so this is the way that most of you will do this. And honestly, this is the way I encourage you to do it. Just use the calculators or use Excel. There's probably apps you can get. I'm sure there are probably free ones you can get that will do this too. So I've included this just so if you want to spend a little bit of time and pause the video here and go back and go, yeah, let me make sure I know like what buttons to hit and in what order to make sure that I get the right, solve for the right thing. So like in the first one, interest rate, you should solve this one for 11%. Just plug in everything as I've listed it here. If you're looking for, in this case, the present value, then again, plug in everything else and then solve for the PV. And then for the last one, make sure you plug in your N as 20, payment is 30, PV is negative 902.29, future value is 1,000, because that's what you'll get back at the end. And then just solve for your interest rate. All right, now let's switch a little bit and talk about long-term debt, the basics of long-term debt. So all long-term debt securities are promises made by the issuing firm to pay principal when due and also to make timely interest payments on the unpaid balance. So the maturity of a long-term debt instrument is the length of time the debt remains outstanding with some unpaid balance. So of course that balance is going down over time. So short-term debt securities or unfunded debt have a maturity of 1 year or less. Long-term debt securities typically have maturities of more than a year. So think about the year as the cutoff, right? If it's less than a year, it's considered short-term debt. If it's over a year, it's considered long-term debt. So debt securities are typically called notes, debentures. I know it's a strange word, just go with it, or bonds. So the difference between notes and bonds is original maturity. So with those of 10 years or less being called notes, and longer term issues typically being called bonds. So that's not strictly true. There are some variances there, but we can go with that. So the major forms of long-term debt are public issue and privately placed, with the main difference between privately placed is directly placed with the lender and not offered to the public. All right, so let's talk about that weird word I was just talking about, the indenture. So the indenture, you could think of this as a deed of trust. It's basically just the agreement between whoever's lending the money and whoever's borrowing it, and it just lists out the terms of the debt issue. So you're going to see things like the basic terms, total amount of bonds issued, description of amount, the total amount of bonds issued. If they put any property up as collateral, which they probably would do, because it's usually this is a secure instrument, then the description of the property used, maybe the address, the value and stuff would be listed in there. Repayment arrangements, call provisions. The call provisions just speaks to if they want to call in the bond early so they can get out of paying all those future interest payments. Are they allowed to do that? If so, when, etc. And then details of any protective covenants. Typically, a trustee, so for it says a bank, it's usually going to be an investment bank. So that would be like your Deutsche Bank, for example, Credit Suisse, is appointed by the corporation to represent the bondholders, and the trustee, and typically again the investment bank, must one, make sure that the terms of the indenture are obeyed. So look at all your bullet points there. Manage the sinking fund. The sinking fund just speaks to the money that the company is, over the course of the term of the bond, is putting aside to make sure they have the money to pay the bondholders back at the end. And then they also have to represent the bondholders in the event of default. All right, so let's keep talking about terms of the bond. So the principal value is just stated on the bond certificate. The par value is almost always, not always, there are very occasionally some differences, but it's almost always the same as the face value, and the terms are used, synonymously. So corporate bonds historically have always had a face value of 1,000. Municipal bonds often could the par value could be five. It could be 5,000. Treasury bonds with par values could be 10,000 or 100,000. Those are and it doesn't have to be that. You can really make it whatever you want. Those are just very common. So corporate bonds are usually in what we call registered form, meaning the registrar of the company records the ownership of each bond, with payment being made directly to the owner of the bond. Bonds can also be what we call bearer. You may have heard the term bearer bonds if you read like the London Times, the Wall Street Journal. In which case the bond is issued without record of the owner's name. It's just the payment's just made to whomever like holds the bonds, like who bears the bond, right? Couple of issues with that. Difficult to recover if the bonds are lost or stolen. And because the company does not know who owns its bonds, it cannot notify bondholders of important events. So yeah, there are advantages to bearer bonds. As you see, there are also some disadvantages. So what about security for a bond? So debt securities are classified according to the collateral and mortgages. Think about like mortgages as like liens, loans on property, real property. Loans and collateral and mortgages used to protect the bondholder. So mortgage securities are secured by a mortgage on the real property of the borrower. So the property typically involving real estate, so like land and buildings. Just like if you take out a mortgage, right, it's secured on the house. The legal document that describes the mortgage is called a mortgage trust indenture or trust deed. The mortgage could be on a specific property, for example, like as I said, like a specific railroad car, or a blanket mortgage, more common, could pledge all real property owned by the company. So the bonds usually represent unsecured obligations of the company. So a debenture is really just a type of unsecured debt, typically with a maturity of 10 years or more. So the debentures are usually longer term. Most public bonds issued in the US by industrial and financial companies are typically debentures. They're usually unsecured. Now that's good and bad because if it's unsecured, then it's not secured, it's not collateralized by a certain asset, but it does mean that it will usually pay a higher interest rate because if you're a bondholder and you have an unsecured bond, then it's more risky. All right, so what about in order of repayments? This is where we got this term seniority. So seniority indicates preference in position over other lenders. with debt sometimes labeled as junior or senior to indicate seniority. So sometimes debt is subordinated, um, and holders of such debt must give preference to other specified creditors. So it basically means that in order of, like if a company goes under, if it goes bankrupt, if they become illiquid, then person A, bondholder A gets paid before bondholder B. So thus bondholder B would be considered subordinated. Okay, and debt cannot be subordinated to equity, so debt will always be paid out first. Bonds can be repaid at maturity, at which time the bondholder will receive the stated or face value of the bond, or they may be repaid in part or in entirety before maturity. So typically, early repayment is common and is often handled through a sinking fund. That's kind of what I was talking about earlier, like the money that the company is, putting aside to make sure they have the money to pay the bondholders back at the end. Um, some examples of sinking funds, you can see these 3 bullet points. This is not an exhaustive list. There are other types too. So some sinking funds may start about 10 years after the initial issuance. Some could establish equal payments over the life of the bond. Some very high quality bond issues establish payments to the sinking fund that are not sufficient to redeem the entire issue. So then I mentioned this briefly earlier, but I'll mention it again. We'll just go into a little more detail here. The call provision. So the call provision is an agreement giving the corporation the option to repurchase a bond at a specified price, notice this, prior to maturity, so before it was technically supposed to end. So corporate bonds are typically going to be callable. That's good for the company. Call price is usually above the bond's stated value or the par value, with the difference between the call price and the stated value being what we call the call premium. So think about this, right? Like if you're a bondholder and you're like, at any point, this company could just say, hey, we're taking the bond back. Guess what? No more interest payments for you. You would probably want to have there needs to be a higher price on that, right? Perhaps a higher interest rate to compensate you for the extra risk that you're taking. Deferred call provisions prohibit the company from redeeming a bond prior to a certain date. During a period of prohibition, the bond is said to be call protected. That's usually in the first few years that they'll do that. A make-whole call is a new type of call provision where bondholders receive approximately what the bonds are worth if they're called. To try to find the make-whole call price, what we'll typically do is we'll get the PV of the remaining interest. We'll discount that back, and then the principal payments at a rate specified in the bond indenture. So again, think about that deed of trust. Protective covenants. So protective covenant limits certain actions that might be taken during the loan's term, especially to protect the lender's interest. So a negative covenant is a sort of like thou shall not type of covenant that limits or prohibits actions the company might take. So I won't go through all these, but like a couple of examples could be you got to limit it, you got to limit the amount of dividends paid according to a formula. The firm cannot merge with another firm. So that's a couple of examples of negative covenants. Positive covenants is sort of a thou shalt, so kind of the opposite, right? So a type of covenant that's specified an action the company agrees to take or a condition the company must abide by. So examples could include you got to maintain working capital, so think about assets minus liabilities, at or above some specified minimum level. Or just one other one, the firm must maintain any collateral security in good condition. So that way, if they have to sell it, they know that they can get enough to pay off the bondholders. And then bond ratings. So firms often pay to have their debt rated, with ratings serving as an assessment of the creditworthiness of the corporate issuer. So there's various bond rating firms. Probably two of the leading ones are Moody's and Standard & Poor's. You may have heard of the S&P 500. Definitions of creditworthiness issued by Moody's and S&P are based on how likely the firm is to default and the protection creditors have in the event of a default. So the highest rating you can get is basically a triple A. Investment grade would say it's probably a triple B to a B, double A. And then really anything that's kind of below that, you're getting down into really what we call junk bonds. A lot of companies have a leverage with what we call junk bonds, which basically means they're not really rated. They would really fall below any sort of investment grade. Rating agencies like Moody's and Standard and Poor's, I mean, they're usually pretty close, but they won't always agree on the ratings. Government bonds, Uncle Sam, biggest borrower in the world by a wide margin. Think about how much, $34, $35 trillion worth of debt. The government is certainly borrowing a lot of money. So they do this through things like treasury bills, treasury bonds, U.S. treasuries. They don't really have any default risk. They're considered to be very safe. Treasury issues are exempt from state income taxes. That's why a lot of people like those municipal bonds because there's a sort of they don't pay as good of a rate as other bonds, but you also get the tax exemption. So when all said and done, you're probably more looking at an apples to apples. Um, State and local governments also borrow money, of course, by selling notes and bonds. That's how they finance, transportation and infrastructure projects, schools, building universities, so on and so forth. So taxable versus municipal bonds. So let's say like taxable bonds are currently yielding 8%, while at the same time, municipal bonds of comparable risk and maturity are yielding 6%. So which is more attractive to an investor who is in a 40% bracket? So somebody earning a lot of money. What is the break-even tax rate, and how do you interpret the rate? So for an investor in a 40% tax bracket, a taxable bond yields 8% times 1 minus, think about this, like 1 minus zero point 0.4 is just taking out the tax. So it's like saying you're getting 8%, but after taxes, you're getting 4.8%. So the municipal bond is way more attractive because it's paying 6%, which you don't have to pay taxes on, right? So if we let T stand for the break-even tax rate, then we can solve the break-even part as follows. Pretty straightforward. So just put in your first interest rate, 0.08. Don't put that in as 0.8, that'd be 80%. Put it in as 0.08 times 1 minus T, and then that equals 0.06, right? If you solve for that, then you're going to get T equals 0.25. So what they're saying there is an investor in a 25% tax bracket would make 6% after taxes from either bond. So then at that point, you're sort of like indifferent between the two. You could take either one because you come out the same at the end. All right, zero coupon bonds. So these we just call these zeros. They don't actually make any coupon payments. So what that means is you don't actually get the interest payments throughout the course of the bond. What your earnings, if you will, your capital gain, if you will, is because the bonds are sold at a deep discount, and then you get the full amount at the end. So that's kind of how you're making your money. So for tax purposes, the issuer of a zero coupon bond deducts interest every year, even though no interest is actually paid. So it's kind of good deal for them. Similarly, the owner must pay taxes on interest accrued every year, even though, again, no interest is actually received. So it's an attractive investment for tax-exempt investors with long-term dollar-denominated liabilities. So things like mutual funds, pension funds, because the future dollar value is known with relative certainty. So it's a pretty good option. So how are bonds bought and sold? So the one thing I will say, and they make reference to this in this chapter, is a lot of students don't realize this. A lot of people don't realize this. The bond market is way bigger than the stock market. A lot of people don't realize that. Most trading in bonds takes place over the counter, what we just say OTC. One reason why the bond markets are so big is that the number of bond issues far exceeds the number of stock issues, and there are really two principal reasons. So the first one, a corporation would typically have only one common stock issue outstanding, whereas a large corporation could easily have a dozen or more note bond issues outstanding. And the second reason is federal, state, and local borrowing is enormous because they've got all these things they want to finance, and they just don't have enough money to do it without borrowing money. So a financial market is transparent if it is possible to easily observe its prices and trading volume. So like example on the NYSE, it's possible to see the price and quantity for every single transaction. However, with the bond market, it's not as transparent. It's often not possible to observe either one of those, unfortunately. So just a little bit here about bond price reporting. So in 2002, transparency in the corporate bond market began to improve as new regulations required dealers to report trade information through what we call the trade reporting and compliance engine. So we just call that TRACE. So TRACE bond quotes, you can look those up online, you can get them online. So each day, representative prices for outstanding treasury issues are reported. So we're looking at things like the bid price. This is the price a dealer is willing to pay for a security. The ask price is the price a dealer is willing to take for a security. And then the bid-ask spread is just the difference between the bid price and the ask price. Treasury prices are quoted as a percentage of face value. So if the bid price is 132.23 and the face value is 1,000, then the quote represents them both added together. Change in the ask price from the previous day, measured as a percentage of face value, is also quoted. So the reason to do that is so you can kind of see how these things are trending over time. And then this is worth talking about too, just in the context of, because we're talking about bonds and borrowing that of course people are paying interest on. Real versus nominal. These terms, if you've taken an econ class, you may know these terms. So real rates are interest rates or rates of return that have been adjusted for inflation. That's actually really frankly more meaningful, in my opinion. Nominal rates are interest rates or rates of return that have not been adjusted for inflation. So suppose prices are currently rising by 5% per year. In other words, the rate of inflation is 5%. An investment is available that's going to be worth 115.50 in 1 year, and it costs 100 today. So notice that with a PV of 100 and a future value of 115.50, the investment has a 15.5% rate of return, right? The problem with that is, and it's not wrong, it's not untrue to say it has a 15.5% rate of return. That's not considering the effect of inflation. So what is the nominal rate of return? So what is the impact of inflation here? So let's imagine like pizzas cost $10 at the beginning of the year. So with 100 we can buy 10, right? But because the inflation rate is 5%, pizzas will cost 5% more, or 10.50 at the end of the year. What does that mean? That means that your purchasing power has declined, and of course you're going to be able to buy less pizzas. Okay, thanks for watching, and I will see you all in another video very soon.